thanks for the introduction. I'm Glenn Patterson, and I was one of the guys who was lucky enough to win a grand prize in the December contest. So what I'd like to talk about tonight is the Wholesale Express and what went into constructing it and what the thought behind it was, and give you a little more detail on it. Hopefully the intent is we all end up with enough loose change in our pockets that we can buy this $1 million Oyster 57 sloop that we see in the picture.
Not yours?
No, not yet. Okay, next slide, please. We've already seen this from Joe, but once again, we need to have this disclaimer and risk disclosure. Joe went through the words on it. I won't bother rereading it, but something to keep in mind. The bottom line is do your own homework, do your own back testing, and make sure that it works for you. Next slide, please. Okay, so the goal of the portfolio was really to hit what I think was being the 3 R's of investment. Reality. I really worked at trying to attempt to narrow the gap between the paper results and the actual performance that we might see from the portfolio in practice. And secondly, the risk factor. This intends to address the risk needs of people that are in their 70s. I'm in my mid-70s, and I know that my risk profile has changed quite a bit since I was 45 or 40. And last, returns. Notwithstanding the intent to get low risk, I'm still greedy. I still like to make a lot of money on this and try to do it safely. So those are the 3 key factors going into it. I'll talk about each one of those in a little more detail. But give me the next slide. Addressing the issue of reality, one of the key things I think is to use walk-forward testing, or in sector surfer terms, forward walk regressive tuning, FWPT. This hopefully minimizes curve fitting, and the intent is to deliver results that are closer to reality than if you're just doing simple backtesting. The other thing that I did is to further discount the reported results to try to approach real world results. This is a judgment call, but this comes out of listening to some investors that I have a great deal of respect for, Al Sikowski, John Nichols, and others, who have given me some tips about discounting that to try to reach a realistic end goal. Third factor is to use funds and ETFs that have substantial volume and longevity. The better the volume, the tighter the spread, the easier, more efficient trading we get. And with longevity, we got a lot more historical data that we can use to plug into our formulas and develop more rigorous results. And last but not least is to try to minimize strategy clones. One of the things I found as I went through and looked at the various candidate strategies is that a lot of them were almost clones of one another. Out of 12 components that would go into a strategy, there might be some that had 10 in common, for example. So one of the goals is to try to minimize those clones.
Glenn, could you explain the forward walk testing a little more?
Yeah, I mean, this is a topic you can spend a couple hours on, but basically when you do traditional back testing, what you do is take data that you know and try to develop a methodology or a curve that fits that. The problem is you're looking in the rearview mirror. You know that data. So with forward walk testing, what you do is to go through that back testing process initially, but then you move it back in time and walk forward without knowledge of where you're going. And you refine the curve and the system as you walk forward with new data that you don't know. Now you're looking through the windshield instead of the back rear view mirror. And it gives you results that are a lot better. Typically what I found when I apply forward walk testing is that the results may not change a lot in terms of gain of returns, but usually the risk goes up quite a bit. Drawdowns will go up, other risk factors will go up as well. And the intent is to really develop things that are based on solid data and not just looking in the rearview mirror.
So how long ago did you start this forward walk?
I started using it probably summer of last year,
So
May or June of last year.
You got 9 months of data or
Oh,
8
oh,
months
no,
of data?
no, I'm sorry, I didn't understand your question. One of the things you want to do with forward walk testing is to use as long a period as possible. And in Sector Surfer, the way you do that is to have as early a born-on date as possible. Because the born-on date determines when you start doing the forward walk progressive tuning. And you'll see that later on. I'll show you an example of a strategy I picked out that had a nominal born-on date of October 2013. I reset it to 2001 and then did forward walk testing from that date forward.
So there are different algorithms with forward walk versus what he uses?
Yeah, forward walk retunes itself every 6 months, roughly. I think it's every 125 weeks. It retunes itself based on what it's seeing, and it attempts to make the system more accurate each time it retunes. So the longer period you can use for forward walk, typically the better results you're going to get. So one of the things I did throughout the work on this portfolio is to try to reset the born-on date to as early a period as possible. Now with mutual funds, you can do that easily because a lot of them have been around for a very long time. 1980s are not at all common. With ETFs, it's a different matter, and a lot of ETFs have only been around since 2001, 2002. And if you're talking about leverage ETFs, the dates may be more like 2005, 2006, or even newer. But you do want to try to get that born-on date as early as you can, given the components that you have in the strategy. Next slide, please. Okay, risk. One of the interesting things I found, I saw a study from the Stanford Biz School about how investors react emotionally to investing. And the key takeaway from that article was that a typical investor reacts 7 times more strongly to a loss than he does to a gain of the same magnitude. And looking at my own experience, I think that's true. If I get a 20% loss, I am really torqued. If I got a 20% gain, I say, well, that's what I expected. You know? But you do react a lot more strongly to the loss than a gain, and I think as you get older, that factor goes up. Older investors basically want and need lower risk. They want smaller drawdowns, they want fewer losing trades, preferably no losing years, etc. So the risk goals of this portfolio are to maximize Sharpe ratio, to shoot for over 1.5. And let me just talk about Sharpe ratio for a minute. This is a ratio that came out of William Sharpe of Stanford University. And the work that he did in the course of developing this was one that netted him a Nobel Prize in economics. Essentially, the Sharpe ratio lets you analyze how much return you're getting in a portfolio in exchange for the level of risk that you're assuming. And I think it's a great ratio. Some people say they like Sortino better. When Mr. Sortino wins a Nobel Prize, I'll switch. But in the meantime, I really like the Sharpe ratio as a figure of merit. I wanted to keep max drawdown to under 20% and the real drawdown, the one that's realized when you're trading, when you make a trade, at under 10%. And no losing years. Next slide, please. On returns, the goals were annualized gains across all time periods of over 30%. And after listening to Al and John Nichols, I decided to cut that by 1/3 in an attempt to realize an expected gain that would be real world and something I could bet my account on. So if you do that and you discount those 30% gains, you end up with a discounted 20% per year, and that fits within my wheelhouse in terms of what I'm trying to do. Okay, next slide, please. So this is what the screenshot of the strategy looks like. We ended up with a Sharpe ratio of over 1.8, max drawdown a little under 19%, rounds off to 19%. consistently in the mid-30s in terms of returns, 34, 33, 35, averages about 34 all the way across the time span. And this one I like a lot. It's only 0.09% chance of a 15% loss in any one year on a year-to-year probability basis, as opposed to 21.9% for the S&P. So that's a real added benefit for this whole thing. And the equity curve is a pretty straight ride. Another thing that obviously you want to achieve. And the last thing is you want to get as much area under the curve here as you can to the right of zero. And you can see there's quite a bit of area under the curve there, and there's smaller area on the negative side. The more you can shift that to the right, the better.
What does that mean, that curve?
Well, it's a quarterly return probability distribution. And it just indicates that if the white line is the S&P. Okay, so this is the S&P. And the yellow line is this portfolio. The more you can shift it, that curve to the right, the more you're in the profitability area and the less you're in the negative returns area. And you can see the difference between the S&P and the portfolio in that curve. Next slide, please. Okay, this shows it in a little more detail in terms of the numbers. This portfolio kicked off in 1988 with some of the mutual funds that are a part of the portfolio. And between 1988 and the present, there have been 102 trades. Of those, 86% were winners and 14% were losers. We mentioned before that the probability of a year-to-year 15% loss was only 0.09% versus 21.7% for the S&P. This is one that's very important. I mean, the real drawdown. So this is not the drawdown that occurs while you're in the trade. This is the drawdown that occurs when the rubber hits the road, when you actually execute the buy and sell at the designated period. So that's when it really hits you in the pocketbook or your account. And that's only 8.4%. So it got underneath that 10% threshold that we wanted. The returns, as you can see, we're pretty much in that mid-30 range. Last 5 years was a little better. Last year was not quite as good. One of the interesting things I found out with this portfolio is that on years when the S&P did very well, when it was, let's say, over 25% or more, the portfolio would trail that. There have been 4 years like that, I think, in the last 20 years or so. On years when the S&P was doing single digits, this portfolio really thrived. And years when the S&P went negative, this did quite well as well. There were no losing years from 1988 to the present.
Well, is this spreadsheet something that Sector Surfer outputs?
Yeah, I shortened it, but this is just the download. If you go to the strategy, you can do this on a strategy or you can do it on a portfolio. In this case, if you go to the portfolio and you say download the historical trading results, then there's a button there, Sid, that you can press on and it says, give me a CSV file. And it just pops up in Excel and Bob's your uncle. Okay, got it. So it's very handy. The rest of the data that I left off of here has the detailed trades year by year, returns year by year, and also the detailed trades of those 102 trades. You can look at each one of them. And then at the very bottom, it's got some very interesting information. It has the forward walk fine-tuning information. And Al did a great presentation a few months ago about how to use that data and how to twist the knobs in the advanced option feature, which I'll talk about next. If you can give me the next slide. So the optimizing approach that I tried to use was, first of all, download the Hall of Fame spreadsheet. Secondly, just to reorganize the columns to focus on the parameters that were important to me, which in this case were Sharpe ratio, 10-year gains. And that only takes a few minutes, but it makes it a lot easier to look at and work with. Thirdly, to select the candidate strategies, I started out with about a little under 20 of these to take a look at. Yes?
When you say reorganize the columns, what do you mean by reorganize?
I'm going to show you in the upcoming slide.
Sure.
I ended up with a little under 20 strategies that met some rough parameters in terms of gains and Sharpe ratio. And then I had to throw out some of them because a lot of them turned out being clones of one another. And then I also threw out ones that didn't give me the right mixture of sectors, asset classes, and countries. Those were kind of the three things that I wanted to try to see a good, healthy mix of in the portfolio. Next thing I did was to try to apply a maximum length forward walk progressive tuning process to each of the promising strategies. And for the top strategies, after I'd gone through the tweaking on them, for the top strategies, I then went ahead and tweaked them with advanced options for each strategy to try to find the max performance under FWPT. For those of you who were lucky enough to see Al's presentation a few months back, he did a great presentation on how to twist the knobs in the advanced option feature to get optimum performance. And so I tried to pick up on that. And the last thing I did was to verify the portfolio weighting of each strategy to try to maximize the Sharpe ratio for the overall portfolio. Again, this is sort of an iterative process to go through.